Welcome to the Veloris Capital Monthly Review for May 2026. I'm Ronnie and I run our trading operations. My co-founder, Lucas, who leads the quant and technology side, will join me through the numbers. Let's start with performance. In May, the strategy returned positive 9.5%. That beat the S&P 500, which gained 5.3% by more than 4 points. The Nasdaq ran hotter at 10.6%, so we trailed it slightly this month. Year to date, we are up 29.8% against 11% for the S&P 500. Since we began in November 2025, the strategy has returned 40.4%. Our largest drop from a peak stayed at 8.8%, a little shallower than the S&P 500.
Thanks, Ronnie. I'm Lucas. I lead the quant and technology side. Let me take you under the hood. Memory and storage did the heavy lifting in May. Micron led the book, up 87.8% for the month, with DigitalOcean and SanDisk close behind. On the other side, Cameco, Celestica, and Lumentum lagged, but each move was small. All 15 positions are held at the same weight, so no single name can dominate the result. By sector, memory and storage was our biggest cluster at roughly 27%, balanced by materials, cloud and electronics, energy, and one large bank.
Thanks, Lucas. Here is what we published this month. The Cockpit ran 6 deep dives and insights. We covered the memory supercycle through Micron and SanDisk, and the developer cloud through DigitalOcean. TTM Technologies gave us the AI and defense angle. We also stepped back to explain how the whole portfolio captures the AI boom while staying balanced. Finally, we showed why time in the market is the real driver of compounding. Let me start with Micron. We own it because it is one of just 3 companies in the world that build high bandwidth memory, the fast memory that every AI accelerator chip needs. The most recent quarter delivered $12.20 in earnings per share, a 31% beat, and the 9th straight quarter ahead of estimates. Revenue grew 196% over the past year, yet the stock trades at under 8 times forward earnings. The main risk is the memory cycle if supply runs ahead of demand in 2027.
Thanks, Ronnie. DigitalOcean is next. It runs a simple, predictable cloud platform aimed at small technology teams, and it recently added a service for running AI models in production. Unusually for this group, it is genuinely profitable at a 16% operating margin, while many direct cloud rivals still lose money. Revenue re-accelerated to 22% growth last quarter, and analysts raised next year's earnings estimates 14 times with no cuts. The valuation is rich, so we hold it for the earnings growth, not for a higher multiple.
Back to me for SanDisk. SanDisk is our flash memory pure play, the storage chips inside phones, laptops, and AI data centers. It spun out of Western Digital in early 2025. Revenue grew almost 80% over the past year, 5 times the broader technology sector with a 34% net margin. Its joint venture with Kioxia is the world's second largest flash production base, which keeps costs low. Even after a big run, it trades at about 23 times forward earnings against roughly 65% expected earnings growth.
Let me take TTM Technologies. It makes the specialized circuit boards and radio frequency parts used in 2 growing markets, AI data centers and defense. Revenue grew 23% over the past year, and its profit margin is the best in its direct peer group. Earnings beat estimates for the 6th quarter running, and analysts raised forecasts 4 times last month with no cuts. The stock is up about 449% over the past year, so the return from here depends on the company delivering the growth that is already expected. That raises a fair question. Are we simply an AI fund? Not quite. 10 of our 15 holdings sit somewhere on the AI supply chain: chips, memory, storage, optical networking, and power. The other 5 are deliberately outside it: a bank, 2 miners, a defense name, and an energy refiner. They give the portfolio different return drivers when technology sells off. The AI weight is an outcome of our screen, not a decision to bet on one theme. We rebuild the portfolio every month so it follows the data. One more piece worth flagging is the long game. The most important skill in investing is patience because of compounding. The S&P 500 returned about 10.9% a year over the last 33 years, and the longer you stay invested, the better the odds. Every rolling 15-year window in that record finished positive. We are two professionals with more than 40 years of combined experience, and we invest our own capital alongside copiers. That is why we ask anyone who copies us for at least 12 months as a fair test.
Thanks, Lucas. Let me cover risk. This is our F1 dashboard, the risk overlay. Every night, the system recalculates more than 20 risk indicators across markets and sets our equity exposure for the next day. Through all of May, it held steady at 49% in cruising mode. That is not a market prediction. It is a measured stance, enough exposure to take part in the rally with cash held back in case conditions turn. It is built to control how far we fall, not to call tops or bottoms. Looking to June, the optimizer refreshed the book. It chose 8 new names, including AMD, Ciena, Quanta Services, and Sterling Construction, and it closed 8 others, among them Taiwan Semiconductor, Raytheon, and Valero. 7 names stayed, including Micron, SanDisk, and DigitalOcean. Remember, the optimizer decides which qualified names to hold, not how big each position should be. Every holding carries the same equal weight.
I'll close out the calendar. On the radar for June, 2 of our holdings report earnings: Ciena early in the month and Micron near the end. The calendar also brings the inflation prints, the Federal Reserve rate decision on the 17th, and a quarter-end rebalance. These are the events most likely to move both markets and our overlay. Dates are estimates, so confirm them before acting.
Thanks, Lucas, and thank you for watching. That is May. If you would like to follow along, you'll find our cockpit analysis and weekly reviews on veloriscapital.com, plus our newsletter, the Pit Lane Briefing. If you choose to copy us on eToro, the platform mirrors our trades proportionally into your own account, which you control at all times. A reminder, past performance is not an indication of future results, and your capital is at risk.